The pre-market futures indicated the markets were going to open lower. The trading of Friday was evident that the bulls could not keep the market up above the T-line. And then today's lower open was indicative of the fact that the bears were not out of the picture just yet. However, the candlestick investor could much more easily see that the NASDAQ, which opened right on the 50-day moving average, bounced there, and just the graphics of candlestick analysis would have shown that it started trading positive from where it opened, creating a green candle, and also was more evidence that the 50-day moving average was probably acting as a support level. This allows for much more quicker and accurate decision making based upon what's happening as far as short positions, that because it looks like with the fact that the stochastics were in the oversold area, or the markets were in the oversold area, that there was better probabilities that if we saw continued buying today, that the short positions weren't going to be backing off very much. It was time to close short positions. Our recommendation on Red Robin Gourmet Burgers was based upon this dumpling top, that if it broke this level right here, there could be another strong wave to the downside. However, the fact that we started seeing that they weren't trading at below this level and that they were supporting in here allowed us to move much more quickly to tell us to cover our short positions, because we could see much more clearly that this was now becoming a support area because of buying versus a place to be shorting stocks. That same decision-making process was included in Diebold, where Diebold had failed right here at the 50 in a downtrend, telling us that more than likely we were in a still a steady downtrend. However, on Thursday of last week, we saw some buying, a little bullish harami. Told us that they would probably be trading back up to test the T-line, but then backed off. But then today, we started to see some more buying, with stochastics getting closer to the oversold area. This is just very simple analysis to tell us that this area is probably now acting as support versus allowing this to become a downtrend, continuing in this downtrend overall move. This told us the probabilities are starting to go against the short positions. Go ahead and cover the short position. Now the reevaluation could be that if they came back down over the next few days back below this level, now the downtrend continues. But at this point, with stochastics much closer to the lower end of the range and telling us that you're in an oversold condition, that the probabilities were not as great anymore to remain short, cover the short positions, and look for other positions that are going to produce better profitability. Such as identifying the classic pattern, as in Funko, FNKO. You can see the fry pan bottom breakout. You can see the strong price move. You can see where exuberance came into the trade, where they gapped it up in the overbought condition. The profit taking brought us back to the T-line. Now we can see the next pattern setup, a J-hook pattern, which is not uncharacteristic. That's why we call this the classic pattern. Fry pan bottom breakout produces strong price move. A J-hook prerequisite is a strong price move. So it's not unusual to see a fry pan bottom breakout, profit taking, and then the next wave being the same as this wave right here. VNet, same scenario. Look at the left-right combo coming back up through the T-line, telling us we have wave 1, wave 2, going into wave 3. The advantage we have with candlestick analysis is, number one, we can see exactly when the bulls are stepping in, and number two, we know what type of magnitude of moves are based upon what human nature usually does, graphically depicted by the Japanese rice traders' candlestick analysis. That'll be it. We'll see you in the chat rooms.